Greetings, everyone. My name is Greg Sweeney. I'm one of the investment managers at Bell Institutional Investment Management. Thank you for joining us for this quarterly segment on the outlook for the markets and the economy. This presentation is being recorded prior to year end, so I'm not able to speak specifically on how the year end is closed, but I can talk to about how things have happened up to this point. So let me begin by wishing you all a very great 2023. And so let's just kick things off. So last year was unpredictable, but I would add to that, so is every year. I think what's unique about last year, 2022, is that how quickly perceptions changed. You know, economists were calling for the Fed to shock and awe the economy with a 50 basis point increase in March of 2022. We did get a 50 basis point increase, but not until May. And to give you some idea of how fast perceptions changed, we finished off the year with four in a row, 75 basis points, which is 0.75% increase in the Fed funds rate. So pushing interest rates much higher, at least for the Federal Reserve's short-term interest rates, much higher in 2022. Stock market is volatile. I'm not telling you anything you don't know there. Bonds, though, had their worst performance in 100 years, and that's one of the topics we want to talk about is a 60-40 portfolio that I think is getting a bad rap right now. Real estate was down, and investors had really no place to hide from the declining markets in 2022. So let's talk a little bit about some of the topics that might be on investors' minds right now. And what I'd like to do is I'd like to start by saying that, you know, if you spend 15 minutes a year trying to figure out the markets and their volatility and why they're doing what they're doing, you've probably wasted somewhere around 12 minutes of your time, right? They're just not predictable. And so the topics today that we're going to talk about are inflation, which we think is important to a lot of folks out there, interest rates, the prospects for a recession in 2023, a 60-40 portfolio, and you might be wondering, what in the world are you talking about, Greg? A 60-40 portfolio is a portfolio that's 60% bonds and 60% stock and 40% bonds, and it's a traditional allocation for a lot of investors. And we have some market commentators calling for the death of the 60-40 portfolios. Frankly, we would disagree. And then the last topic we're going to talk about is a little bit of what the 2023 might look like moving forward. So let's talk about inflation first. We've seen inflation at levels over the last 12 months that we haven't seen for almost 40 years. Inflation reached a high of about 8.5%. It's currently right around 7%. It's a big range in the last 18 months from close to zero all the way up to 8.5%. It's the highest interest rate we've seen, inflation rate that we've seen in 40 years. The Fed tells us that they're targeting an inflation rate of 2%, so going back down to a 2% target inflation range. We think, given what the situation as we see it right now, 2% is a little optimistic. We think 3% is probably closer to where inflation is going to settle in. I've got a gold arrow on this chart suggesting that in the next 12 to 18 months, we expect inflation to get back down to about 3.5%. Still above that Fed's 2% target, and then of course our 3% longer term outlook is still slightly above that over the next 12 to 18 months. But that's where we think inflation is going in the coming 18 months or so. So it's going to be down significantly from where it is today. The next thing I'd like to talk about, and you have to bear with me on this slide because I realize it's busy, but it's interest rates. And I've got a slide here showing the inflation rate and then the 2-year Treasury rate right next to it. So what we've seen, you know, since that black line I have drawn on there, which is December 2008, since that time we've gone through what I would call is a long-running monetary experience. This is where the Federal Reserve, who implements monetary policy, kept interest rates for the most part below inflation rates. We can see the interest rate on the 2-year Treasury being the red line and the inflation rate being the blue line. And we can see for the last 14 years, the red line interest rates were predominantly below the inflation rate. Economically, we call that free money. when interest rates are below the inflation rate, it's considered free money. We still have a free money environment right now, given inflation at 7% and Fed funds somewhere in the mid 4% range. But this period of free money created an explosion of demand, okay? And particularly the explosion of demand in the wake of the pandemic when there was generous fiscal policies coming out of Congress. But monetary policy is the primary tool for reining in those excesses. So even though the Federal Reserve's monetary policy experiment ended with the fiscal packages from Congress in the wake of the pandemic, it's now up to the Fed to try and rein in those excesses. And that's why we see interest rates moving higher right now, is to rein in the excesses from those fiscal policies from Congress. So it wasn't always this way. I have that black line drawn on there because I want you to see that prior to December 2008, interest rates were predominantly higher than the inflation rate, which means there was a real cost of money prior to 2008. So we talk about the experiment since 2008 and what it looks like prior to 2008. Now the question, of course, is will we go back to a period prior to 2008, or will we go back to easy monetary policies like we've seen over the last 14 years? And our sense right now is that we're going to go back to a period where the actual interest rates are above the inflation rate. So it's going to be an actual cost of money. That's our best guess right now in terms of where interest rates are headed. Are they going to remain where they are today? You know, probably not. They'll probably drift a little lower. Interest rates are important to a lot of you because it has a significant impact on housing. And yes, I do have a slide on interest rates and housing coming up next. But we don't see our strongest case as a continued period of free money like we've seen since 2008. We think we're going back to a period of interest rates being above the underlying inflation rate. So let's talk a little bit about interest rates and housing. The green line on this chart is the average 30-year mortgage rate. It's on the left scale. Currently, it's about today I think it's about 6 3/8% or so. That chart shows it being somewhere around 6.5. I did put this together a week and a half ago or so. But you can see this significant rise in the underlying 30-year mortgage rate over the last 12 months or so. Now, typically, higher interest rates means that the price of housing would go down, but you can see that housing prices have really not come down that much yet. And it's hard to tell, sit here and say, oh yeah, we think housing prices are going down, because housing prices are really localized markets. It depends upon how much housing supply is available, how many people are looking for housing, all sorts of things like that. But if you look back in the 06, 07, 08 period, you'll see that as interest rates rose, it took housing prices a while to respond to those increases in interest rates. And even when interest rates went down, it took housing prices a while to respond by going up in the wake of lower interest rate environments. I guess a lot of people look at housing as an investment, and it is an investment. I'm going to give you a little bit different perspective, though. I think it's an investment in your quality of life. I don't see it being as much of an investment like a bond or a stock, like you're used to. So it's an investment in your quality of life, and not like a bond or a stock. So I guess my what I'm trying to say is, if you find a house and you can afford it and you want to go out and buy it, I say go ahead and do it. If interest rates come down in the future, you can look to refinance. But this is going to be a market that's in flux for a little bit, just in general. Again, real estate is localized, and I can't tell you exactly what it's going to do in various different markets, but it's safe to say that there's probably some downward pressure on housing prices in the wake of this higher interest rate environment. The question that we get a lot is and you hear about a lot on the news right now, is what are the prospects for a recession? The Federal Reserve keeps calling for a soft landing. The definition of a soft landing is the economy slows down but does not go into a recession. The graph I have here is simpler than the one on the previous page, The blue line is personal income. The red line is gross domestic product. Personal spending makes up about 70% of gross domestic product. That's why historically you see that blue line and the red line moving at about the same rate. The government spending, business spending, and exports minus imports makes up the other 30% of GDP, but 70% of it is driven by personal income. And what do people do with their personal income? They spend most of it. And so that's why you see the blue line being very consistent with the red line, blue line being income, red line being gross domestic product. You can see, though, that got all wacky in the period of that yellow circle there, right? That's during the pandemic. Personal income had a couple of spikes. Again, I mentioned the stimulus money coming out of Congress in the wake of the pandemic. This is everything from the CARES Act to the American Recovery Act. PPP was in there for businesses. But long story short, that spiked personal income, right? Well, after businesses started to open again, what did people do with the personal income they received from those stimulus packages? They spent it. And that's how GDP got driven so much higher coming out of that yellow circle than it had been for eternity prior to that, okay? So the gap that we see between personal income and GDP prior to the pandemic was about 2.3 trillion, and the gap we see today is 3.5 trillion. Now, long-term averages would suggest that GDP is going to close that gap and be somewhere between $2 and $2.5 trillion, which means that we expect the economy to slow and go into a recessionary period, which is declining GDP, to come back in line with personal income, right? So GDP probably drops somewhere around $1 trillion this year. Okay, from 26 trillion or so where it is right now down to 24 and a half, whatever the case may be. But it's going to be more in line with the growth of personal income, just like it has been in the past. Now, I use the word recession, but I want to caution that I'm not using the word recession in a bad way, okay? It just simply means that GDP is coming back down in line with personal income. And that's why I'd say that GDP or any recession that we get in 2023 is probably more of a headline than it is a problem. It's just a function of personal income, and it just has to come back in line in the absence of these unusual stimulus packages that we saw in the wake of the pandemic. So recession is our highest probability call in 2023, but not a problem recession, more of a headline than it is a problem. Everyone wants to know where the markets are going from here. That's normal, right? Stocks, I don't have to tell you, stocks have been under pressure in this year, and they come under pressure during periods of a slowing economy. And I just told you on the previous page, our best guess is for a slowing economy in 2023. So that means the stock market probably remains under pressure to some extent, okay? Now, I don't want you to use this as an opportunity to try and time the market and not invest in your 401k or save your retirement, right? I just want you to understand that if the markets are under pressure, it just means that you get a better deal on any purchases that you make this year. So again, don't use this as a reason to try and time the market. Right now, the market expects stocks to earn somewhere around the S&P 500, to earn somewhere around $230 a share next year. And right now, stocks are trading about 17 times earnings, which means the S&P 500 is somewhere in the range of fairly priced today. Now, it wouldn't surprise us in a recessionary environment, even though it's a mild recession, that earnings go down, call it 220 or 210. So if you move that star on the horizontal bar on top over to the left, and then, of course, a recessionary environment makes investors less excited about the market. So that star on the vertical side might go down from 17 to 16. But if you move those stars around, it gives you some idea of where we expect the S&P 500 to move throughout 2023. Again, this is not a reason to time the market. It's just the money you put to work. You're going to buy things on sale compared to where they would be. I want to talk a little bit now about the 60-40 portfolio. And the 60-40 portfolio, as I mentioned earlier, is a portfolio of 60% stocks and 40% bonds. It's a very popular allocation as people work their way towards retirement over the long term. Now, on this chart, you'll see that the dark blue lines are the stock market, that's the S&P 500, and the light blue lines are the bond market, represented by the Bloomberg Aggregate Index. Now, if you look at that light blue line, you'll see it rarely goes negative, right? That's supposed to be the stable portion of a portfolio, right? That's the 40% that we look to really never have a negative return. Yes, there's a little pop in there every now and then. There's one in 2013. There's a big one in 2022, right? At the time this chart was prepared, the S&P 500 was off at about the same amount that the bond market was off, okay? That's unusual, but that's exactly why we see market commentators now calling for the death of the 60-40 portfolio. The reason we disagree is because now interest rates where they're at is the first time in about 10 years that you're able to get a reasonable return on bonds. So yes, 2022 was definitely hard on a 60-40 portfolio, but we think moving forward, a 60 portfolio is anything but dead. So if we look at now how a 60-40 portfolio performed, you can see that 2022 was a bad year, pretty much for the reason I just pointed out here, is that the bond market and the stock market in 2022 are off. We're off at least about the time of this chart, about the same amount. But that's why we're seeing this drawdown in a 60-40 portfolio. You rarely see that in the past. We saw it in 2008, not because bonds did so poorly, but because the stock market was off 37%. And bonds limited that decline to portfolio decline of 20% rather than that decline of about 37%. So anything but the death of a 60-40 portfolio, yes, 2022 is tough, but we expect it to be better moving forward. Okay, so now, of course, you know, investing is a long-term process, right? And what I want to do is take a minute and talk about long-term returns. Long-term returns on stock are about 9.5%, and long-term returns on bonds are about 5%, and real estate is somewhere in between. Those are the three major asset categories where people invest. Volatility occurs regularly. Yes, 2022 is excessive volatility, but I want to use a quote from Yogi Berra. He says, if you don't know where you're headed, you'll end up someplace else, okay? And what I'm trying to say is stay focused on the long term, have reasonable expectations for returns. I say that because since that period of free money I mentioned earlier, beginning in December of 2008, we've had unusually high stock returns. Matter of fact, this return on the S&P 500 since that time has been about 16%, believe it or not. That is not normal, right? We've got a lot of people thinking that 16% is normal. It's not. 9.5% is normal. And when we go through a period where markets return to that, right, you need to have those reasonable expectations. So keep reasonable expectations, stay focused on the long term, and don't be a Yogi Berra. Definitely you want to know where you're going long term so you can end up in the spot that you want to be. Thank you very much, everybody. Look for another segment from us in about 3 months. Wishing you a great 2023.